Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Good morning, everyone. Welcome to Cut to the Chase. My name is Zhong, and I'm standing in for Daniel, who is taking a break this week. Talking about a break, the key event over the weekend was how OPEC Plus broke with its previous message that it would hold supply steady, and instead announced a surprise oil production cut of 1.65 million barrels per day. This builds on the earlier production cuts of 2 million barrels per day from late 2022. Saudi Arabia led the way by pledging a 500,000 barrels per day supply reduction, while fellow members UAE, Kuwait, and Iraq followed suit. Russia also extended its oil production cut of 500,000 barrels per day through 2023 from its original timeline of June. Though the impact of this is likely to be limited given the sanctions already in place. In its announcement, Saudi Arabia called the cuts a precautionary measure aimed at supporting the stability of the oil market. Since our 2023 outlook, we have been highlighting that OPEC Plus is likely to intervene should oil prices fall below its average budget break-even prices, approximately in the low 70s. Hence, the action does not come as a complete surprise given the level of prices. The US was critical of the move, but they likely face limitation on what they can do given past releases from the strategic petroleum reserves and the US shale oil industry that is less responsive to price gain compared to a few years ago. So, how did the markets react? WTI crude oil jumped above $81 on the news before settling back below 80. Similarly, Brent oil shot up to just below $86 before consolidating at around 84. Currencies of oil exporters, including the CAD and the Norwegian krone, strengthened on the news as well. In the near term, we believe WTI oil prices are likely to overshoot our 3-month forecast of $70 per barrel to the upside, given the extremely low open interest and positioning. It's unclear how much of the planned cuts will result in actual volume reduction, as some of these producers are already producing below target, and OPEC Plus have historically failed to fully implement agreed cuts. However, the move has the potential to push the market into a deficit in the second quarter, versus earlier expectation of a surplus. On the margin, this could be positive for the energy sector equities. We recently closed our overweight on this sector, and any price rebound could offer an opportunity to reduce exposure. From a macro perspective, higher oil prices too boast the risk that inflation expectation creep up once again. The magnitude will be important, of course, to judging the extent to which these impact Fed policy and bond yields. We will be monitoring the market inflation expectation to gauge just how big a risk it could be in the coming days. That's all the time I have today. If you enjoy this podcast, please help us to like, rate, and share it. Thanks for tuning in, and speak to you again tomorrow.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.